All right, so welcome to our fifth Wook in review. We're trying to make do. We're traveling. I'm traveling this week. I'm in Las Vegas. Trying to make do with a makeshift setup here. I'm Rod Alsman. I'm the managing director at Wook Capital Management. Um, just uh, Jesus, it just it's really difficult to do this with one screen when you're used to multiple screens. Um, I'm just trying to read a disclaimer real quick, and then I'll kick off conversation. So just need everybody to know that Wook Capital Management and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, with all that out of the way, we're going to review some of the major topics going on impacting the world this past week and in the news, and also kind of talk about what's going on in energy markets. There's obviously a lot of moving parts, spans the geopolitical, political. It really is kind of all runs the gamut of the impacts in energy markets. So definitely want to welcome folks with expertise in the space to chime in what they might be seeing. But we're going to kind of walk through the prepared presentation. Joe, maybe you could pin the thread up in the nest, uh, and then that way
Yep.
folks who are on Twitter only can read along with it. If you haven't signed up yet for the newsletter, the link is in the thread, and also is in the Wook Discord where we're streaming the video of the presentation as well. The presentation audio and video file will be available on our Wook Capital YouTube afterwards with the integrated presentation. So, this week's topic, we're going to kind of go through the highlights of the week. I think it's impossible to talk about what happened this week and ignore what happened in the United Kingdom. Obviously, a few weeks ago, we talked about the kind of crisis in the gilt market and what happened there. I have this graphic John Authors had included in one of his write-ups this week, just kind of showing the wild ride that the gilts had relative to U.S. 30-year Treasury. So the long-dated gilts, the long-dated UK bond, right after last month now, it feels like what a whirlwind, right? This new government that's already out after 6 weeks in the UK, the shortest prime ministership ever. Liz Truss's former chancellor Kwasi Kwarteng had this massive tax cut, supply side, Reaganomics type logic that the markets completely rejected. Folks started selling the long dated gilts. Rates started rocketing. You see on the left hand side here in September, and that forced the Bank of England, to intervene to basically switch on quantitative easing, to keep that long dated gilt market from getting out of control, which was forcing sales and pension funds, forcing liquidation. So really, havoc was stayed briefly. We had this continued wild ride of uncertainty in the market, and finally you had Kwarteng resign, and then Truss resign a few days later, and now back to close to parity with the U.S. 30 years. So I think the takeaway for me is that currency issues, and I think emerging markets in particular. Obviously, the UK is not an emerging market, but the way their currencies moved and the way their yields have moved, maybe they're reverting toward that direction. But I think you'll expect to see more wild movements as the U.S. dollar keeps appreciating, the U.S. rates continue to rise as the Fed seems to have no intention of pausing imminently. And whether something breaks internationally or not, to me, it seems like that's the highest risk, or one of the highest risk vectors is something in like emerging markets and currencies markets. What breaks there remains to be seen. Similarly with rates kind of being impossible to ignore, I have pulled up another highlight is this not so lucky 7%. The 30-year fixed rate mortgage average rate is pretty much right smack dab at 7% now, which is pretty incredible, right? It's just night and day. We talked about this a few weeks back. I don't want to belabor the point, but the massive delta in cost for the marginal home buyer now, to borrow for a $500,000 loan, for example, at 7% versus say 3% just 12 or so months prior. It's a massive in your monthly interest cost, your housing affordability. A lot of those indicators are at multi-decade lows. This chart I think just shows this is a Wall Street Journal Freddie Mac chart just showing the rate of change, and you can just see how rapid the pace of change was. Over 120% move year over year, which is just completely out of line with any other previous rate hike cycle, at least in terms of mortgage rates. So obviously, it's weakened the housing market. Housing market is in a recession. I've seen many experts argue the housing market's in a recession. Obviously, it's not the entire economy, but housing freight markets appear to be heading towards recession. And depending which expert you ask, some will say we're already in one. Some will say we're going to be in one in 6 to 9 months, 12 months, whatever. Definitely the Fed's rate moves are seen most quickly moving through this housing space, right? And we will see the delayed effects of monetary policy flowing through the balance of the economy, I think, in the coming months. So, the Fed, as we talked about in the past, is still looking at lagging indicators for the most part, right? CPI is an output. Those inputs, go in, and it takes time to flow through, whether it's owner equivalent rent. Um, so like seeing easing in producer prices, we want to see that, I think, to expect that to flow through to consumer prices. The Beige Book did talk about consumers pushing back on price increases for businesses seeing that. So, that could be good that we're not getting into a wage price spiral, perhaps. But we'll continue monitoring it. Okay, so with all that out of the way, we're gonna pivot the conversation to talk about energy markets, talk about this global energy crisis that's going on a little bit. Again, welcome folks up. Once we get done with the kind of prepared comments, I'm gonna again with the video presentation kind of show some different graphics on screen. I know Joe had pinned the thread that has some of the corresponding graphics, so I'll try to refer to them, but you can again follow the video live in the Wook Discord, wook.gg, if you haven't yet joined. So, look, it's October 21st. It's now been what, 8 months ish since the invasion of Ukraine. I don't think most people expected it to continue on for this long. At least most of the punditry that I recall following at the onset of the war. So there's a lot of knock-on effects that are continuing to kind of flow through the global economy from Russia's invasion of Ukraine. I think at its core, it's important to remember that Russia is a primary provider of fuel, in the form of natural gas, to really power European industry and European um, heating. And as we getting closer and closer to the winter, we've seen natural gas prices really just have a lot of wild rides up and down. But in terms of the cost delta from where things were, prices of for Europeans are many multiples of the 10-year average. So natural gas prices have um, have surged. The graphic for Europe's energy crisis that's in the thread just kind of shows for each country, on a percent of GDP basis, how much is this incremental energy cost costing them. And of course, some countries like Italy are pretty heavily indebted and have perennially been viewed as, like Greece, kind of the weak men of Europe, and the most at risk in Europe. And um, we don't have the same European, I guess, sovereign debt crisis going on right now as we did in the early 2010s when Draghi kind of stepped in and backstopped, said, "Yeah, look, ECB, we've got your back." Um, but you got countries like Germany who are spending about 2% of GDP, Italy 3% of GDP, others maybe more like 1% of GDP on incremental housing costs, not housing, excuse me, fuel subsidy costs, so that their citizenry doesn't have bills that would wipe out their savings. So this extraordinary elevation of the price of of natural gas is definitely causing real headwinds for the European economy, the European consumer. So I put this graphic in the uh, newsletter, kind of just showing kind of some of the constraints. Just this isn't pipelines, this is liquefied natural gas. So you think about how is Europe getting energy? They've been for many years, of course, transitioning or seeking to transition towards renewables away from coal and now natural gas as well as nuclear, depending on the particular country that we're referring to. But generally speaking, Europe has been transitioning, trying to transition that direction now. The I think this whole energy crisis kind of comes down to the spread between where we are today with the necessary infrastructure and investment to satisfy the energy needs of citizens of European countries and, of course, other countries in the world. Um, Getting from where we are today to where these countries want to be in their target net zero or whatever their target states are for 2030, 40, 50, et cetera. So you see on this chart, liquefied natural gas import terminals, they're mostly in Western Europe, whether it's in the Netherlands and the Iberian Peninsula, Italy, France. There's operational ones, like one in Germany, but really a lot of the imports in Germany had been coming from Nord Stream, coming from Russia. You have other pipelines that are coming through Eastern Europe that are also being impacted by the war. Now you can see that a lot of green dots on this graphic showing a lot of planned expansion or planned incremental liquefied natural gas import terminals. But there's only so many LNG terminals and LNG ships out there. So, the massive uptick in demand for LNG due to the substitution from just natural gas piped in, that sent LNG surging. Coal has also been surging, right? Because Europe is importing thermal coal as well. Because if your alternative is freezing to death versus burning some coal, while the environmentalists may certainly not like that, I think they'd prefer to be alive. So thermal coal prices have also really mooned. But LNG, uh, as and again, I'm sorry, I'm on one monitor and I'm trying to have my screen organized as best I can. Um, but goodness, the LNG market has, sent shipping charter prices, skyrocketing. The Wall Street Journal was talking about how those rates are around 500,000 a day now and may rise above 1 million as winter approaches, and that's many multiples up from what rates were in 2021 and prior. The fleet expansion graphic that I included, you can see, really LNG had taken off with kind of the natural gas revolution, I guess, that happened stateside in the in the mid 2000s, right? This is a growth space that the U.S. is a big exporter. The U.S. does provide nearly 50%, or has stepped up to provide nearly 50% of Europe's LNG import needs. However, Europe's LNG import capacity, kind of going back to the fact that they just only have so much terminal capacity presently, can only satisfy 40% of its energy needs. So they're going to have to satisfy their energy needs with alternatives, and that may be coal, that may be extending the lives of nuclear power plants. Each country is a little bit different. The French, of course, have a big fleet of nuclear plants, but there's been reporting about how much are under necessary maintenance right now. And of course, it's not made any better when you see refinery workers striking in France. So you've got limited supply of refined products like gasoline and diesel fuel in France, and the refinery workers, some of them are striking, and that's leading to more social unrest and strikes in France. Now, that's obviously not new to France or unique to France, but I think that this is something we'll continue to see likely as winter arrives and continues as energy prices really strain consumers in Europe. And it's not just Europe, right? The all of this demand, this incremental demand for liquefied natural gas is impacting other markets. So in New England, in the Northeast United States, where the US already has very low, really multi-decade, 4-decade low level inventories of distilled refined products like diesel fuel and natural gas inventories are also very limited. Um, you've got New England that is, a major portion of its winter heating is satisfied by imported LNG because New England doesn't have enough pipeline capacity connecting it to the gas producing regions of the country, like say the Marcellus Shale across Pennsylvania, Ohio, West Virginia, kind of that region. There's no easy, cost-effective way to transport the natural gas from the Marcellus into New England. So New England typically will import liquefied natural gas. But since the Europeans are hoovering up all of the supply in the market, it's pushed prices up, as I just noted. And now you're, of course, seeing northeastern United States consumers getting pinched. So there's a lot of moving parts to all of this. A big, I think, issue, a core issue, right, is the lack of capacity. And while Europe has its own issues with reliance on Russian import and their, goal of becoming greener faster, perhaps than other parts of the world, the U.S. Um, when it comes to refined products, they've not been investing in capacity. So um, I had a graphic that I don't think we included, but I'm just going to blow it up here. This is a graphic from the U.S. Energy Information Administration just showing U.S. refinery capacity. So the U.S. hasn't built a new refinery in 40 odd years, more than 40 years. I think late 70s technically. There's been minor kind of additions to existing refineries, so capacity has marginally increased or had marginally increased up until 2020 when there were a lot of kind of early closures of some refineries because 2020 came along, demand fell through the floor. Some of these refineries were near the end of their life anyway, and major oil may have said, yeah, let's just shut it down now. There were a lot of sales of some of these refineries for very low sums just to get them off big oil's books. But in 21 and 22, U.S. refinery capacity fell from 19 million barrels per day to 17.9 from the EIA's latest data point, and that's as of Jan 1. There's been a lot of maintenance, and a lot of these refineries have now been running kind of at full on blast. There's been several refinery disasters that have been in the news in the last few weeks and months. You don't want these things running all out all the time, but as I noted, with refineries, capacity being constrained, with inventories at multi-decade low levels, and with demand through the roof, what does that lead to? You have the profit margin, the crack spread for these refiners is at or near all-time high levels, and it's been fluctuating at or near, up and down somewhat. And there's some delta between, say, gasoline versus diesel. Noting that diesel in particular has remained exceptionally tight, both U.S. and abroad. So those crack spreads have really gone kind of haywire, gone through the roof, and obviously the president, whether he knows it or not, um, that the you hear from the current administration kind of calling the oil companies, profiteering off of this and gouging, and really it's kind of the market doing what the market does. If you tell it we're not going to be investing in this space, you won't get investment in the space, and you'll get chronically undersupplied markets, chronic underinvestment. That then when you get these sorts of blow up situations, it causes problems. So um, scrolling through again the presentation, just this is always such a great graphic. I think the products derived from a barrel of crude oil graphic. It's mostly liquid fuels, right? It's mostly gasoline, diesel fuel. You also get your jet fuel, your heavy bunker fuels that get burned on tanker container ships. Asphalt comes out of a, a barrel of crude oil. Lighter fuels for like home heating and commercial heating. some other, propanes and butanes, and then tires and other chemical products, that get kind of, all of that comes out of that crude barrel of gasoline. And again, that's what we're talking about with refiners. So you can't have the fuel that goes in your car or that powers the big rigs that move freight across the country, um, without having refineries. So, it it seems clear that this space will be with us for many decades to come. But the questions are, how do you manage this very long energy transition? The Biden administration now is sending the market some price signals saying that we will buy fuel, we'll buy crude for SPR, the Strategic Petroleum Reserve, at $72 per barrel to replenish, because right now the oil, kind of futures curves are in steep, backwardation. Right now, the spot price of a barrel of, crude oil is much higher presently than, say, 2, 3 years out. So if I'm a exploration and production, um, you know, sh drilling company looking to put more, capacity online, I'm not gonna get that spot price today. I'm probably gonna get, the 2-year, futures, or 3-year. I'm gonna try to lock in at those prices, which are only in, what, the 60, 70, per barrel. And, that's where, if you could see some more coordination with, the government sending better price signals and not just shouting at industry and calling them, bad things, you might actually get investment. And, obviously, there's the other side of the coin where the industry overinvested for many years and were poor, allocators of capital, and they overbuilt in, the two through to 2014 or so, when, oil then tanked. And, investors don't want to see them just making these big investments if they're not going to return free cash flow to shareholders. So you've got kind of investors turn their heads on it, then the governments have discouraged it, and now we've led again to this kind of energy crisis. Kind of lastly, finishing up the prepared remarks that I have here in the newsletter, you have the continued drawdowns from SPR, which obviously is good for prices in the short term. It does obviously reduce future optionality, going from 600, 700 million barrels, um, 600 and change prior to this, down to now we'll be under 400 million in short order. And it's going to, drop rapidly, to, lowest levels since the 1980s in terms of how much, crude oil is available in Strategic Petroleum Reserve. So, I think it's valid to say, right, this is a unique situation. You have the largest land war in Europe since World War II, that has obviously distorted markets. Using the SPR does make sense, right? What else is it there for, to address these shocks? But, the lack, I think, of coordination and the antagonism between industry and administration is a headwind to hopefully solving some of these problems for the longer term. But it is good to kind of see some commitment to buy at certain prices. I think it would be best if there could be a longer term agreements to buy, to maybe try and flatten that curve out, sell spot, buy long dated futures. If I'm the administration, right, that would kind of help balance the market better. Um, so, again, I included the quote from Biden, and my message to the American energy companies is this: you should not be using your profits to buy back stock or for profits, not now, not while that war is raging. Obviously, there's elections in a few weeks here stateside. So, that message is more, I think, political than realistic. Um, a lot of these energy companies didn't make money for many years, and, they're now making profits, and they're more apt to actually pay back their shareholders, who've many of them have been waiting years to, get a good special dividend, or see a buyback of capital stock. Um, they're certainly, when they hear this kind of rhetoric, discouraged from reinvesting in, more, exploration and production, or whatever. Um, so again, unfortunately, it doesn't look like things are going to get fixed anytime soon after the sabotage last month of Nord Stream 1 and Nord Stream 2. No one knows who really did it. The Swedes have asserted they know, but they're not going to tell anyone. German officials, right, think that it's the Russians because the saboteurs took out three of the four pipelines, so that fourth pipeline could be turned on. So, who knows if it was the Russians or if it was the Americans or if it was somebody else. But regardless, there's continued challenges in the globe when it comes to energy. Um, and it's not just the US and Europe, but we kept the conversation focused there. Looking at the time, we spent about 20 minutes kind of walking through that. I'll kind of pause there, Joe, if you want to kind of lob any questions my way, and then anyone who's listening is welcome to join in and ask away as we kind of explored the conversation a little more. And yeah, if we want to segue away from energy too, we can do that as well.
Yeah, I mean, I don't really have any questions for you. I just personally can add comments. I used to live in New England. I'm from Connecticut, and oil prices had really been one of the biggest things that I heard complaints about from people. It's definitely something that really can make or break someone's like personal financial standing is how much money they're throwing away every month on oil, and if they were able to avoid that, they'd be in a much better position. So that's just my personal experience. I think there's I understand why Biden is seeking to put some relief on Americans, but it's clear it can't really last that long this way.
Yeah, it's a band-aid. It's clearly inappropriate, I think, band-aid, right? If you're not going to deploy SPR resources during this environment, when are you? So I think it's reasonable for the president, whether if he were had a D after his name or an R after his name, obviously the other side will be mad at him either way, but just trying to be pragmatic about it, I think it's very reasonable to take that course of action. But it certainly doesn't address the longer term issues. And I put up on my screen and this is obviously not a neutral entity. This is MarcellusCoalition.org. But the reality is you have the resources. You just don't necessarily have the infrastructure to connect the dots throughout both North America and abroad, to move the natural resources from A to B. Like it's kind of crazy to me. You have New England. Okay, it's 53% of its energy is natural gas sourced, and you're having to import LNG from far-flung places like Trinidad and Tobago, and this may have been pre-war, but occasionally even Russia. Um, Whereas if you were to install pipeline infrastructure from Pennsylvania through New York into Massachusetts and into the New England area, that's a much lower cost, a much lower environmental impact to have the pipeline infrastructure moving the um, whether it's crude or other or nat gas, products. It's much better to do it that way than to put it on a rail car or to put it on a truck or to put it on a container ship. And I think it's just difficult to have good conversations because I think a lot of people will go to the extreme of the arguments and not necessarily try and look at it pragmatically. But yeah, I think energy policy, just trying to fix it in the short term is clearly inadequate, and there's really big challenges. And what happens next winter, right? If this war continues for Europe, um, those LNG terminals aren't all going to come online in enough time, for them to fully replenish where their depleted nat gas stores are for next winter if they don't have access to Russian imports. So these are very real issues that are going to play out over the next year or so, and obviously in the next couple of months as well. Um, where I am in Florida, we have pretty low fuel prices, low energy prices for our electricity. We are mostly burning natural gas here in Florida. Um, and I know we have a few nuclear plants in Southeast Florida. Um, you know, it's 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 uh it's more reliable though than say if you're New England and you're relying on these LNG imports. It's like, well, what are you gonna have to pay, on the spot market, if Europe is freezing and they're willing to pay, quite a high premium, you're gonna have to outbid them. And there's other kind of factors like the Jones Act, where like U.S. Ports, it really limits, I think, the competitiveness of like U.S. Port markets, and I don't know. There's just a lot of bad stuff in policy that's made energy a not so good place, like this chronic underinvestment that we kind of alluded to. What are the solutions? What are the right steps? And also, what are the opportunities, for investors? Yeah, obviously the refining space is very constrained right now with those high crack spreads. The question is like how durable are those elevated crack spreads? Will there be like windfall profit taxes, which you listen to the political rhetoric, and it would be hard for one to want to be invested in refiners, knowing that the government, the administration is doing everything in its power to kind of put you out of business eventually, but knowing that you're going to need these refineries for decades to come. Um, it's like a catch-22 we find ourselves in. We have a desire to get to very green energy production, and we push a lot of investment into that space, and the U.S. government's passed a lot of legislation pushing in that direction. But for many years to come, there will be a serious need for fossil energy in both developed and developing worlds. So kind of how do you bridge that? Yeah. But it's 4:40 Eastern, 1:40 Pacific. So, if anybody wants to come on up, add any, they're experiencing energy markets themselves, any ideas maybe they might have, conversation. Don't be shy. Um, And let me not ignore the Wook server, Lowe's down, Scott. I know you used to be a plant operator at an LNG plant in British Columbia, so definitely, if you have any input, I'm not sure if you joined the audio stream, but if you want to chime in, would certainly love to hear your input with that, work experience. I put him on the spot. Um,
Well, he's listening on Discord, so he would have to chime in on the spaces to like actually be able to speak. But
well, I guess then beyond energy, yeah, obviously we talked about the other kind of topics with all the craziness in the UK. Just to kind of circle back on that one, it's pretty pretty bonkers that Boris Johnson may end up becoming the UK Prime Minister again after his uh wild ride as PM, and then his resignation just months ago. He may be back in the saddle in short order here. It looks like the Tories are rallying behind him. So yeah, it does seem like the idea of going and cutting taxes is kind of off the table though in the UK. So it looks like the bond vigilantes showed them who's boss, so to speak. And the market kind of did what the market does. The they were going to have a massive uptick in debt issuance needs in the short order. The market wasn't necessarily going to bear that at the current price point, so they needed higher yield to satisfy that, and it kind of set things in motion. And obviously, it's kind of on pause now with the government that proposed it in shambles and gone. So I doubt Johnson will bash his head against the wall in the same way that Truss just did. But never dull moment in the UK, eh?
Hey, Rod, I actually want to call it back to, I think this was two Wook reviews ago. We discussed Elon's acquisition of Twitter. Yesterday, there was some news that came out. Of course, the market reacted. Twitter's down quite a bit today of the potential for like a federal oversight on his acquisition and whether or not to allow it to go through. I was curious what you thought about that and if you think this was part of some Elon master plan or if he's just going to potentially get lucky and get out of the deal.
Right, yeah. I mean, I saw some people saying, is Elon playing his 4D chess? And he had this, all his tweets were purposefully trying to get him out of the deal. Um, I don't know, man. It's so hard to say. Uh, obviously the only person who really truly knows is Elon Musk, and we can't trust him to tell us. The deal's supposed to close next Friday. As far as I know, it's going to close. That news last night that broke obviously sent the price down. I actually am not sure exactly uh what entity it is that is inhibiting the deal. If anybody does know, and has an informed take, I am no longer personally playing the Twitter arb. I had at one point had a small position, but I do not anymore. So I don't know if anyone's following it closely. It's been quite I mean, I know Hindenburg Research actually did quite well on it. They, to their credit, had when the price had gotten close to the deal price, like in the 50s, they'd gone short. When then Elon sued, they covered in the 30s, so they made profit on that move, and then they went long again and sold out after it looked like the deal would be consummated. So I know there's plenty of people that have traded this Twitter arb. I think Elon is right with what he said at Tesla earnings earlier this week that he's clearly overpaying for Twitter, right? The other comparable social media companies have fallen in value meaningfully since April of this year. Meta has gotten thrashed, Snap has gotten thrashed. Twitter would probably trade down maybe 50% from current level if this deal were to fall apart. But that the beautiful thing of contract law and Delaware is that the Chancery Court, has the final say in this litigation, which is stayed for now. So yeah, will some U.S. Intelligence or national security related thing come into play because of Elon's Starlink involvement and Elon's China ties and this, that, and the third? Maybe. I mean, I think that it's an awfully big stretch to conflate ownership of Twitter with that sort of national security threat, but I'm not the one in that seat, and I certainly don't have a deeply informed view on it. If he does manage to get out of it in the final hour, though, it would truly be musking Twitter shareholders in the most in the worst possible way. Because we've heard now that he plans to cut what 75% of jobs, which you know look, he's if he does end up buying it, obviously his goal is to make money with it, or at least not just lose a lot of money. So, you know, I'm not a software engineer or designer, but it does seem like that's a lot of people working on the Twitter, Blue app that, or for Twitter, to have that many thousands of people. But yeah, it remains to be seen again if the deal will close. Again, if anybody has any takes, input on Elon's Twitter deal, on energy markets, on what's going on in the UK, we certainly welcome you to come on up and share your perspective in the spaces. Or if you don't want to use audio, you can chime in below via text as well.
Yeah, it definitely is mysterious how one day he just seemingly wakes up and decides, you know what, I'll go through with the deal. Um, Maybe legal counsel told him like, "Hey, you're not going to win this lawsuit, Or maybe he has some sort of connection to somebody in government that told him, hey, like this may be able to go away for you should you just agree to the deal going through. Who knows? I mean, if there are foreign investors in his acquisition offer, I could see why you can make a case for it being a national security threat. You can see the previous administration had big problems with TikTok being wholly owned by China, and they forced the United States to get involved. But this is a little bit different rather. Uh, I really am super curious to see how it plays out. I think this is one of the most interesting little business drama like things happening right now. I like watching the stock going up, reacting to the different news. I think it's really interesting, and I'm looking forward to it. I think it's possible that this ends up falling through just some way, you know, and seeing Twitter shareholders might get a little burnt, but who knows? If anyone else wants to add any comments, yeah, just request to be a speaker. We'll throw you up. You can talk about Twitter, energy crisis stuff, or anything else that's relevant to the markets.
We got a quiet bunch today. Small bunch, quiet bunch. But yeah, what else? We can cover really anything market moving, market related this week. It's otherwise, if no one has any other input, we can wrap early. I'm gonna pull up the beige book while we wait and see if anyone wants to say anything.
I can just add a personal real estate market experience. I'm living here in Southern California. Neighborhood I live in is really ripe for flippers. You see a lot of like worn down houses right next to very recently renovated homes that you can tell were done in a way that they would sell for maximum value. They're painted all white. They have black accents. Their driveways are beautifully paved. They have, you know, the renovations that a buyer is looking for, and definitely have seen a slowdown. You know, the construction's kind of halted on a few of them that had construction being done, and just yesterday somebody came up to our door. It was a realtor, and she was like giving away candy to try and get clients. So I thought that was kind of funny. Definitely I wasn't really seeing that happen a few weeks ago, but it seems like obviously, or a few months ago rather. So the times have definitely changed.
Yeah, anybody who added a whole bunch of houses trying to flip in the last few months is probably they're on borrowed time and they're probably hoping they can get out ASAP. But Scott, I appreciate you coming up to chime in. I know you've got a lot of industry kind of related experience in the energy space, and yeah, what's on your mind?
Yeah, as some of you guys know, I'm in the natural gas space, and it's just very interesting to see I guess we've got like the ESG push to reduce pipelines and gas across the board, which is all great when um, everybody has access to cheap money. But as interest rates climb, energy hits the pocketbook of the average consumer, right? So not just reliable energy, but cheap, affordable energy. And I think that's where the dream to have everything electrified was a nice dream. But as we push towards this economic time where now all of a sudden people don't have as much disposable income to spend on a $15,000 heat pump install. I think we're in for, a lot longer using, fossil fuels, natural gas, and other alternative energy sources like those that are cheaper than maybe the visionaries had maybe thought when we embarked down this, we'll call it quote unquote greening of the grid, right? So just very interesting as we move forward on that.
Yeah, I mean, of course, right? It as interest rates rise, these really long-term projects for a lot of these, most of these green projects have very high capex, and the save is an opex save. And if you have really high uh, your your attractiveness of that sort of project, where all of your cash outflow, this massive cash outflow, and zero relative to maybe a lower cash outlay for maybe a fossil project that maybe has higher opex, like it definitely changes the math. There's I think that the big problem is that there is a reality that the world should be kind of all on board with, that for the next, several decades, there's a transition period where, yeah, maybe the mix of fossil declines, but fossil will remain a majority, energy source. I forget what the exact number and exact year, but I'd seen recently. It was like global, fuel or energy sourced from fossil, had fallen from like 85% to 83%. Um, and it was over, I don't know if it was decades or years, but it's like, yes, obviously proliferation of cleaner, greener, energy is a great thing. Um, but you're right, the economic realities, you can't ignore them. And yes, if we want to subsidize more cleaner energy, that's great. But then you have to go back to, well, how much debt does the country that's subsidizing it have? Is that an existential threat for the country? Assuming it's not the United States, and we're talking about maybe a smaller country that doesn't, have its currency as the kind of global you know trade basis for most things. Um, yeah, I was just pulling up a graphic. I was just trying to find a graphic. It's like, there's a lot of pieces of this, because there's the CO2 emissions, and then there's like the actual what I would call like real pollutants, more localized pollutant emissions, of whether it's like sulfuric acid or like nitric oxide, or the stuff that you really don't want to have people breathing in, their lungs and their local communities. Obviously CO2 is more of a global problem, and it's not to say it isn't a pollutant, but breathing in a marginally higher mix of CO2 isn't going to ruin your lungs, or potentially cause you to have asthma. Like if you're, let's say, near a coal power plant that's maybe spitting off some nasty other stuff. But this graphic I just pulled up on this shared screen, kind of shows, coal, biomass has a lot of CO2 in its life cycle. Obviously, the CO2 from stuff like wind and solar is low while it's in operation, but it does still cost a lot of energy to dig up all of the materials to manufacture the the turbines, the to transport and then dispose of. So like there's life cycle costs that need to be considered in all of it. And yeah, I think that the reality is there's no one size fits all. And that's probably, Scott, you could probably agree with that, that there's every kind of situation is going to be unique. A pipeline might work in this region for geographical reasons, and it may not make sense in another one, and so on, right?
Right. And I think too, the in because again my day job, I work in the gas industry, and then by night I'm researching EVs and the battery space, so it's this weird dichotomy, but it's really interesting when you think about, okay, so I always love to do the poll when you're asking people like, okay, so how many people have ever had a power outage in their house, right? And in a group everybody's hand goes up, but then you say, okay, how many of you have had your natural gas supply interrupted? And it's crickets, right? Because so it's this whole like debate between reliability and resiliency, And if we want sustainability, that's great, but like what we see when we've got different markets pushing for heat pumps to replace gas furnaces, and now EV chargers going on to the same electric grid, where's all this extra capacity and coming from? Because now all of a sudden the grid is, for argument's sake, a heat pump is 40 or 50 amps on a 220, and same thing with your EV chargers. Now you're adding close to 100 amps on a residential service. So most customers are going to have to do a load upgrade on their panel, which again, that now that all those costs come back again to the average consumer. And as interest rates keep going, I just can't see this bright future where everybody's going to switch over to EVs, heat pumps, and we're going to switch everything over to electric. And then more to that point is, in places where we've got coal-fired plants, switching those over to natural gas-fired plants, sure, we're not as green as, say, like wind or solar, but it's the percentage gain is such a large gain in terms of reduction of emissions. It's almost silly not to, even though it's not the full zero emissions. It's definitely a reduction. And as CO2, it knows no boundaries, it knows no geographical regions, it's circulating the globe. So if we can work towards that global effort to reduce emissions globally, then without just saying, okay, we have to just full stop on gas, because if we full stop on gas, what's the alternative? And that's where
And what's
this
your
winter.
base load? If you
it,
don't have gas, what's your
it,
base load?
exactly right. So and my concern, I guess, we'll see this winter as we roll into cold weather in Europe with now a constrained natural gas supply. I think there will be a lot of people that may have been, pipeline, deniers, or jumping on the bandwagon to abandon all this, to maybe reevaluate or say, hey, you know what? When it comes to heating my house, you know what? Maybe I will just go for the one that actually works, rather than the one that, quote unquote, might save the globe. Because we've got enough strong engineering brain power behind the problem that we continue to advance the natural gas technology. Like, seen there's companies out there that are making natural gas fired heat pumps that are pumping over 100% efficiency. Using technology like splitting methane from its CH4, it's like chemical makeup. So then you can split out the carbon and the hydrogen. The carbon can be sold back into industry for carbon-based products, and the hydrogen can then be used as a fuel source. So it's not this, like you said, it's not a one size fits all. And I think the technologically advanced regions, yeah, we'll see some really cool technology, and those regions that are the more poverty stricken, we're going to see them switch away from wood burning or coal fired plants to gas or other intermediaries, just to bring the global reduction down, I think.
I think that last part you just said is probably what gets left out of a lot of these conversations, because those of us, you and I are obviously joining from North America, and we're in some of the most advanced economies in the world. And if you're in Africa or Southeast Asia or wherever that hasn't yet enjoyed the benefits of getting to, modernity, they're still burning wood. They're still, it's a wood stove in Indian, home or whatever.
Wood,
Uh,
or even just garbage, right?
yeah,
Like, there's actually a very interesting book I listened to. It's The Moral Case for Fossil Fuels, and it just talks about exactly that. So places like Africa, or regions of the globe that don't have consistent energy supply. Now, you've got medication sitting in fridges in hospitals or clinics that, if the fridge turns off and that medication warms up, it becomes ineffective. And so it's that, like, reliability is
yeah,
key.
resiliency has value, and obviously we were talking about energy, but this was a huge. I don't want to, say it's a buzzword, because it's a real thing. But when I was at Ryder in my last, during COVID, for obviously supply chain management and energy is kind of interwoven in that, resiliency is vitally important, because these brittle, whether it's energy, right? To your point of, if you lose a whole hospital full due to a blackout of all the medication, I mean, you're going to have lots of lives lost as a byproduct of, hey, well, at least we emitted a little bit less carbon during this day. So there's clearly a bunch of trade-offs to try and optimize, and it's certainly a challenging optimization problem with a lot of moving parts, especially with the geopolitical considerations. So, there's no clean answer that, no pun intended, that people like those things, but unfortunately, it's very muddy in the real world. But you make very valid points, like that these are, you know, we could be as idealistic as we want, but that's not going to solve real world problems.
And I'm blanking on the city or the country, but oh, I think it was Bangladesh. I think it was their entire electric grid blacked out. They lost, I think, 140 million, like essentially customers, or like 140 million people without electricity. And it wasn't just like, oh, they lost, a couple pieces of equipment. They fully blacked out. And the problem is, like, how do you restart a natural gas fired generator when you got no power, right? And it's this whole like, power is all great, but you need something to back it up, right? And that's the, again, resiliency. And it's that whole um, it's like, if you break it down to three, you can say, what do you want? Do you want sustainable, reliable, or affordable? And pick two, right? Like
Yeah,
you got, like, you can't have it all. You have to say, okay, which is most important, for each region and each area, right?
definitely. It's not easy, and we've seen these different global pacts, obviously Paris most recently, and kind of like trying to find the right balance, because you've got, of course, countries like the U.S. who've been historically the primary emitter. We've downshifted in the U.S., right? We've become much better at how much our per capita emissions are, whereas you've got, industrializing sectors of the world like China that are still building coal plants. And I think you can rightfully see consternation out of some corners of, why are we trying to do, you know, self impose and kind of hold ourselves back, and these Western countries, if say China or others are going to build coal plants. I think that's where natural gas really is, compared to coal. It's just it's abundant, it's available, it's safe, it can be, you know it does it better than coal. And
Yeah.
it seems like you cannot get to a scaled solution without natural gas in the equation, at
Yeah.
least not for, like, unless there's some, real revolutionary battery type technology change, which, we of course want to see over time that stuff happen. But let's live in reality. We know until that, we get like scaled solid state stuff, or like iron, you know like low cost materials that can do like these long duration, stores of energy, like batteries, that there's a lot of novel approaches to it. Whether it's, the energy, what is it, the energy tower, like the gravity storage one. There's a lot of novel ideas in the space, but to get a scaled solution, um, I just don't see it without nat gas.
Well, and the really neat thing, like, that we see with our utility here, is we are bringing on board renewable natural gas. So we actually
That's
capture
right.
we capture methane off of our landfill, scrub it, and pump it back into the pipeline. We capture it off of manure from dairy farms, and scrub it, put it back in the pipeline. So, and I think we've got a model of looking like 20 to, I think, up to 20% of renewable blended. And then also we look at hydrogen. And, if we think of a battery, battery is having that energy when you want it, where you need it. And our below ground gas infrastructure actually can work in that battery stage. And I've seen some interesting reports where using green energy, or places where energy is always being produced but it needs to be stored. And so when they have that excess energy, you need to deal with it. So what they do, or the theory, is basically taking that excess energy, splitting hydrogen out of water through electrolysis, creating that hydrogen, and you put that hydrogen back into your natural gas pipeline. And now you have a hydrogen blend in your pipeline. And then if you need it down the road, you can pull that hydrogen out for power generation. So you're your gas grid becomes a passive battery, so to speak, in this uh, reliability equation. So it's yeah, it's definitely an interesting journey, and I definitely feel this tension because like you're aware, my reading after hours is definitely in the electric vehicle space and battery space, but then my regular employment is natural gas, so it's um, this weird connection. But again, like we have so much technological advancements yet to discover, and I think that's the piece that we can't just say, okay, we're done with this completely, because we haven't yet figured out how to do it the best way possible.
Right? We just need that lovely fusion power plant to come about. My SimCity 2000 favorite.
Yeah,
Those of you
exactly.
who remember
Yeah.
that game. I mean, I know I've read in the past year several different kind of stories that look, it's still not a commercial reality, but if we can get to scaled ability to generate power through fusion, I mean, that's I guess a coup de grace or whatever. We're not there yet, right? It's not going to happen overnight. But I've seen a few interesting stories in that space. I don't know if anyone's been following or knows much about fusion. I mean, I just pulled up a graphic here from BBC. You're basically, that's how the sun so sun works, right? If we can, have some little localized suns working
Yeah.
on Earth.
Yeah, it's definitely like, and I'm not well versed in the nuclear space, but I know that's another um there's a friend of mine, he's well versed in it, and he's been talking nonstop about nuclear and how it's also another alternative, right? It definitely gets its
Yeah.
shade, like natural gas or any other alternative energy that's not spinning windmills and solar panels, right? But you know there has to be this collaborative approach towards energy, and I think as we get to a spot globally where we realize, like I said a bit before, where we don't need to focus so much on what we're doing in our own backyard, but we need to focus on the globe entirely. And for one area, like my region specifically, we're 98% hydroelectric. Like, do we really need to go after that 2%? Because to get that 2%, it might be a few $1 billion, whereas somewhere else in the globe, that few $1 billion could gain a 20% reduction, right? So it's that.
Yep.
um, but again, how do you get corporate organized entities or utilities to start thinking um, outside of their geographic regions? And is interesting because, being that we've got regulatory approval, we've started buying renewable natural gas outside of our actual gas grid, and because there's people making it, and it kind of works like a bank, so to speak, where we actually will buy the renewable natural gas, kind of on like a credit bank type um, system, because we're able to actually pay the premium for it, which then reduces, um, on an accounting level, kind of the amount of gas you're consuming. But yeah, it's definitely interesting.
I pulled up a graphic that I'm sharing in the Wook server, just kind of comparing the energy density of uranium pellet versus oil, nat gas, and coal. And it's just, nuclear, I think, has gotten like a bad rap in some corners. Nuclear is kind of like the unsung, like if you really want to get some scaled, like renewable, or green, I guess, let's not maybe call it renewable, but for example, a 1 inch tall uranium pellet has the same energy density as 120 gallons of oil, a ton of coal, and 17,000 cubic feet of natural gas. And that's 1 inch uranium pellet. So, yeah, there was a good odd lots. I hadn't listened to it yet. I kind of read the summary from about a week or so ago. Um, oh, Jesus, brain fart. Just talking about uh, like how your nuclear plants are basically like built today. They're very much built like airports, where each one is custom. it has its own unique calibrations, sizes, terminal features, etc. And ideally, if you want to scalably build out nuclear power generating capacity, you want to have them more like airplanes, where every plant is small, same modularity. It's not built to spec every single time. You can actually get some sort of scale benefit, building the same plant in all locales. So you just think about how much uranium we do have, how dense that is, and the amount of waste. Obviously, you do have the nuclear fuel output, but when you think about what that waste is like compared to what your output is from coal or even burning oil, it's a pretty compelling alternative, I think. And there's obviously a lot of people who feel strongly about nuclear in both directions, but it gets kind of left out of the equation. And it's like, and we have this incredible power source that is safe. I mean, there are risks, but on net, it's very safe. And it's just we haven't really scalably produced these nuclear plants, and nuclear plant builds have been at like a trickle, and there haven't really been any. There's been like one uh, stateside. It's not really been moving forward at all. Um, but I think I just saw somebody bought Westinghouse. So who was that? It was bought for 7.9 billion. Uh, the big Canadian miner Cameco Corp and Brookfield Renewable Partners bought Westinghouse. So yeah, I mean, nuclear gets left out of the conversation, but clearly
And
it's relevant.
it is relevant. And what we see, I think, in British Columbia, I think it's still illegal to mine uranium right now, right? So it's this like it's this whole shift that we have to get to. But
Yeah. And I'm just reading the bottom line from Axios. Westinghouse Tech is in nearly half the world's existing nuclear reactors, with Financial Times noting that it could benefit from a push to replace suppliers to the more than 30 Western reactors that operate on Russian technology. So, yeah, again, it's there's a diverse array of options available. British Columbia and parts of Canada, of course, have the luxury of hydroelectric and a lot of clean power. And that's just not a thing that works everywhere, right? You need to have the right geographical,
exactly.
you need to be able to put a dam up that doesn't disrupt things. You need to have water. It's
Well, and that's the rub too, right? Because everybody says, "Oh, well, it's hydroelectric, it's green." And it's like, yeah, it's green right now, but how many trees did it have to get enough capacity there, right? And that's the rub, right? So it's the yeah.
for sure. No, great discussion, and Scott. I appreciate you jumping in. Again, if anybody wants to chime in, any of their personal input or insight in the energy space, kind of, look, there's no easy answers to this stuff. I think, like you said, Scott, it's a series of trade-offs, and it's trying to optimize around the various trade-offs that each kind of source has. But where we sit today, there aren't really a lot of good solutions that I see, right? If you simply have capacity constraints that can't get alleviated overnight, right? It takes time to put up new refining capacity.
Yeah.
It takes time to build LNG terminals. And these things, you can't just snap your fingers and fix them. And the sad thing is, unless we try to look to make longer term policy where these energy companies can invest, and it may be investing in fossil, if they don't feel like they can safely, make a risk adjusted return, then they won't invest, and they'll return that capital to shareholders. And unfortunately, while Mr. Biden may not want them to do that, that would be the prudent thing to do if they can't, you know, get the math to work, given elevated risks and uncertainties in investing in new, production capacity.
Yeah, and maybe I'll leave on one note, and then I'll mute myself and leave the floor to anyone else. But I think the biggest hurdle I see just in the general population, and maybe this is just a, a call to action for those interested, is just that energy literacy piece. Really knowing the diversified approach that we need to take, and being aware of not just like, you know, adhering to, you know, maybe what Greta Thunberg has to say and saying, hey, this is the only way forward, because what works in one geographic region, like in BC, where we can use hydroelectric, doesn't work in Florida, where, you know, but the sun always shines, right? So your solar actually works, right? So it's, you know, this collaborative and distributed network that we need to get. So I think just taking that, you know, out and informing yourself on the industry, and yeah, I'm glad to chat more for those that are interested. But yeah, I'm going to
Yeah,
mute
there.
myself now.
Thanks a ton though, Scott, for that input. Yeah, and look, I say this a lot, but I think Twitter in general is actually a great resource to learn about these things. There's a lot of folks in the oil and gas space who kind of host calls and are sharing their they may work full time in the space, they may be experts in the space, and they're just kind of sharing their insights freely on these different spaces calls. And obviously Twitter's not the only resource out there. There's plenty of other ones, but I think you're right. Energy literacy, understanding, really what's going on, and that there's more to it than just these buzzwords and sound bites. I pulled up on my screen just the U.S. electricity generation mix, and you can see it's all over the place, right? It's the plurality is natural gas, coal is still more than a fifth. Those two right there, though, that's 60%. Add in nuclear, that's another a little less than a fifth. And then renewables gets you your last fifth. So you got 60% fossil, a fifth nuclear, a fifth renewables. And obviously that will keep trending higher, I think, to renewables, but you're not going to see coal go to zero anytime in the next couple of years. I mean, you want to see natural gas take mix from coal, but it's not, again, going to completely do away with it. And sure, all else equal, would you rather incremental generation come, assuming you have, the resiliency there, would you rather have incremental generation from something like wind or solar? Yeah. But then it gets back to, do you have, can you balance out load throughout the day, right? Like you think about electric cars, like, you know a lot about it, Scott. You're going to have different kind of periods of time where, energy is getting consumed throughout the day, and there's these different like intraday issues in California. I know that they've experienced for years where they get in the afternoon massive spike in demand, and it's like, can the grid handle that? I know that one thing that was lacking from the Inflation Reduction Act, from what I saw, was that there wasn't really much for transmission investment, and that's another kind of piece of the pie, is like moving the electricity from point A to point B, or so on. You have a lot of different like like the little system operators, the ISOs, and like, think about Texas, where Texas has ERCOT, the Energy Reliability Council of Texas, and they Texas Texas doesn't really play with others with ERCOT, but it's like, is that the most reliable? It might be more reliable if maybe you guys played a little bit better with others. So, look, no, there's no right or wrong answer. These are all things that, I don't know all the answers, and I certainly don't know all about all of these things, but I know a little bit. And I think it kind of gets back to the moral of what we're looking to do here, is just try and learn, try and be open-minded about things, try and get perspectives from people who know more than we do. Um, so yeah, hopefully this has been a good kind of energy oriented discussion. If anybody wants to add any more to it, coming up on an hour and a half here shortly. So if we want to keep the conversation going a little longer, happy to. Would love to hear some other perspectives. Otherwise, though, we can look to call it. If not, so I'll pause, and Joe, see if you had anything else to add, or if anyone else wants to chime in.
Well, I just wanted to add that we held our first Wook Book Club meeting this week. So thank you to those who participated and read the book. It was a really good discussion. That's going to be on YouTube if you missed it. It was on Richer, Wiser, Happier. We're still trying to decide our next book. So if you're a member of our little Wook Capital community, offer your suggestions on the Discord. We have a wook.gg is the invite link. So type that into your browser. You can join our Discord, participate in the next book club, share your market research, share, our open discussion we are always having on the markets. So thank you to everyone who participated. Looking for suggestions on the next one, so feel free to offer
Yeah,
your input.
Thanks, Joe. Good call. Yeah, that was fun. I enjoyed it. It was a good discussion. The recording is I know Joe, you've been finishing it up. We again had to kind of make do with the limited uh, setup that I have here, but I'll be back home next week and we'll hopefully have a little bit of a smoother process getting started at least. So yes, we will settle on the book for next month's book club. This is a monthly thing that we're doing. So our second one will be in November. We'll have the final date and time and book selected by next Friday. We will be sure to include that in the next Wook in Review. Again, if you have not yet signed up, the link to join the newsletter. Um, Joe, I don't know if you included the sign up link. Up, yeah, it's in the pinned thread here in the nest. The last thread in the last tweet, excuse me, in the thread has the newsletter sign up link. And as Joe mentioned, if you're not yet in the Discord server, uh, please check that out, wook.gg. We will continue trying to develop different programming that folks can be learning from and hopefully get different investment ideas from and hopefully just to learn more generally. um, so I do expect us to begin to do maybe a couple of single name securities analysis in the coming weeks. We still want to get all of our I's and T's dotted and crossed on that front, but yeah, more to come from us. We definitely hope that you enjoyed this edition of the Wook Review, this discussion on energy, and we hope you'll catch us next week, same time, same place. So thank you everyone for tuning in, and hope you have a great weekend.